Here is a realistic scenario I have seen in variations across renewal files. A homeowner in Ontario has a house fire in February. The damage comes to $340,000. Their policy had lapsed 11 weeks earlier, a missed payment that triggered a cancellation notice they didn't open. They received nothing from their insurer. They still owed $280,000 on their mortgage. The bank expects to be paid. I've spent nearly a decade as an insurance underwriting analyst in the Canadian insurance industry. I review files, I see outcomes, and I can tell you that scenario is not rare. It happens in variations across Canada every single year. What I'm going to walk you through today is exactly how homeowners end up uninsured or severely underinsured, often without knowing it, and what the financial consequences actually look like when a claim hits without coverage behind it. There are 4 specific situations that create this exposure, and there is a 5th factor that most homeowners overlook entirely, one that leaves them thinking they are fully covered when they are not. By the end of this video, you will know all 5 and exactly what to do about each one before your next renewal. Let me be direct about the scale of this problem. Coverage gaps are more common than most homeowners realize and far more expensive than most can absorb when they occur. Here is what creates them. Scenario 1. Policy lapse. A policy lapses when a premium payment is missed and the insurer cancels coverage. In most Canadian provinces, insurers are required to provide advance written notice before cancellation. Typically 15 to 30 days depending on the province and the reason. The problem is that cancellation notices arrive in the mail, often in an envelope that looks identical to a routine billing statement. They get opened late or not at all, and the coverage disappears without the homeowner realizing it. If a claim occurs after the cancellation date, but before the homeowner has acted, there is no coverage. The claim is denied. What you can do: set your premium to pre-authorized payment and open every piece of correspondence from your insurer the day it arrives. Scenario 2. Non-renewal not acted on. A non-renewal notice is not a cancellation. The insurer is telling you they will not renew the policy when the current term expires, typically with 60 days notice. What frequently happens is the homeowner receives the notice, intends to find alternative coverage, gets busy, and allows the policy to expire without replacement in place. For a period of days or weeks, the property is uninsured. If a fire or flood occurs during that window, the exposure is total. What you can do: treat a non-renewal notice as urgent that day. Your broker should be finding replacement coverage within 48 hours, not 48 days. Now, here is the situation that surprises most homeowners because it involves policies that are technically active but provide no coverage for the specific loss that occurs. Scenario 3. Coverage gap. Standard home insurance policies in Canada cover a defined list of perils. What many homeowners do not realize is what is not on that list. Overland flooding, water entering from outside the structure during a heavy rain event, was historically excluded from standard policies in Canada. Endorsements are now widely available, but they must be added separately. Earthquake coverage is excluded across most of Canada. Sewer backup, one of the most common and expensive residential water damage claims, is typically an add-on, not a standard inclusion. A homeowner with a fully active, fully paid policy can file a claim after a sewer backup event and receive nothing because the peril was never covered. The policy was current, the premium was paid, the claim was denied. What you can do: read the list of covered perils in your actual policy wording, not the summary page. If you have not added overland water and sewer backup coverage, contact your broker this week. Scenario 4. Renovation exclusion. Most standard home insurance policies contain a vacancy clause and a construction or renovation provision. If you undertake substantial renovations, work that leaves the home partially open to the elements or that renders it temporarily uninhabitable, your coverage can be significantly restricted or suspended during that period. If a loss occurs during an undisclosed renovation and the insurer determines the work constitutes a material change in risk, the claim can be reduced or denied. What you can do before any renovation begins: call your broker and ask explicitly whether your coverage changes while the work is underway. Now, I want to address the situation that affects far more Canadian homeowners than outright non-coverage, and that is being significantly underinsured. Your home insurance policy states an insured value, the amount the policy will pay in the event of a total loss. Most homeowners set that number when they first purchase coverage and revisit it infrequently, if at all. Here is the problem. Residential construction costs in Canada have increased between 30 and 45% since 2020. A home that cost $450,000 to build in 2018 may cost $650,000 to rebuild today. If your insured value has not kept pace, you are carrying a significant gap. And in the event of a major claim, that gap falls entirely on you. Most policies include what is called a co-insurance clause. If your home is insured for less than a specified percentage of its true replacement value, typically 80 to 90%, depending on the policy, the insurer will only pay a proportionate share of any partial loss claim, not just total losses, partial losses too. The math works like this. A home with a true rebuild cost of $600,000, insured for $400,000, 67% of true value, and a kitchen fire causing $100,000 in damage. The insurer applies the co-insurance ratio. They pay $67,000. The homeowner covers the remaining $33,000 out of pocket on a home they believed was fully insured. What you can do: request a replacement cost assessment from your broker at your next renewal. If your insured value is below 80% of the result, close the gap. Here is the reframe before the practical steps. Most homeowners treat their insurance policy as a product that runs in the background and activates when they need it. That framing is expensive. Your insurance policy is a legal contract with specific terms, specific exclusions, and specific obligations on both sides. The gaps, the coverage gaps, the underinsurance gaps, the notification gaps sit in the space between what the policy actually says and what the homeowner assumed it said. The homeowners who avoid the outcomes I've described today are not the ones who never have claims. They are the ones who know what their policy actually covers. Step 1. Confirm your policy is currently active. Call your broker and confirm specifically: is my policy active? Is the premium current? Is there any pending notice on file? Step 2. Check whether you have replacement cost coverage or actual cash value coverage. Actual cash value pays the depreciated value, not what it costs to replace. Ask your broker whether upgrading to replacement cost is available and what it costs. Step 3. Get a current rebuild estimate. Ask your broker for a replacement cost appraisal at your next renewal and compare it to your current insured value. The premium increase for closing the gap is almost always smaller than homeowners expect. Step 4. Call your broker before any renovation begins, every time. That conversation takes 5 minutes and protects you for the entire duration of the project. That is the full picture. policy lapse, non-renewal not acted on, coverage gaps for excluded perils, renovation exclusions, and the underinsurance trap that affects homeowners with fully active policies quietly, invisibly, until a major claim makes it visible. None of these outcomes are inevitable. Every one of them is preventable with information and a small number of deliberate actions. If you found this useful, subscribe. I publish one of these every week. Everything I cover comes from nearly a decade of working inside the Canadian insurance industry. I've put a link in the description to compare home insurance rates from multiple Canadian providers. If your coverage has not been reviewed in the last 12 months, that comparison takes 3 minutes and may surface better terms than you currently have. See you next week.